let's go ahead and look at calculating a cash budget. This is typically used by managers to determine whether or not they're going to need additional financing and to make sure that we have enough cash on hand. So in this example, we will use the cash receipts budget and the cash disbursements budget that we've already completed to complete the cash budget. So we'll fill that in for you if you haven't been following along. So Hockey Den will pay a cash dividend of $3,000 in November. They're going to purchase $25,000 of equipment in December. They have an income tax liability of $20,000 from the previous quarter that will be paid in October. They have a September 30th cash balance of $20,000, and they have an agreement with their bank, like a line of credit, if at the end of each month they have to have a minimum of $20,000, so they will borrow. Also, they pay interest equal to 1% of the prior month's ending loan balance. They repay loans whenever the ending cash balance is greater than $20,000. Now, they owe $10,000 on this loan arrangement on September 30th, and they have a 40% income tax rate. They will pay taxes for the current quarter next year. So what we'll start with is our cash receipts budget. We'll start with our beginning cash balance, which was $20,000, and then we can fill in our cash receipts budget. So that means in October they have $102,000 available. Next, we'll fill in our cash disbursements or payments for merchandise. And we do have that as well for October, November, and December. And then from our selling expense budget, we would have got the amounts for sales salaries and sales commissions. We can plug that in. From the general and administrative expense budget, we would go ahead and plug in those amounts. Next, once we filled all that in, it appears that the company would only have $7,200 in their account at the end of the month. If that's the case, they are going to want to borrow so they can maintain that $20,000 minimum. So they're going to need to borrow $12,800. Now, they already had $10,000 previous loan outstanding, so that now gives their new ending loan balance to $22,800. Now in November, again, we've got all this information. It looks like their preliminary cash balance will be $45,072. So they should be able to pay back some of their pre-existing loan. Also, just to comment on the interest payment, since their outstanding balance times 1%. Now, since they had excess cash, they wanted to pay back their outstanding loan, which was $22,800, which leaves them with $22,272, and their ending loan balance then will be zero. So as they move into December now, will come down. It looks like they have $372 after taking into account now the equipment purchase of $25,000. So they're going to have to borrow again going into December, enough money to maintain that $20,000 ending cash balance. So they borrowed $19,628.